You don't blow your account in 1 year. You blow it in 1 hour. One impulsive 1H candle. One oversized position. One deleted stop loss. And a month of disciplined work vanishes into the digital ether. Not because the market was unfair. Not because some algorithm hunted your stops. But because in 60 minutes of emotional override, you abandoned every principle you swore you'd follow. Most traders don't even remember the exact moment they destroyed their month. They remember the feeling, the rush, the justification, the lie that sounds so reasonable in the moment. This one is different. That lie usually shows up on the 1-hour chart, dressed in the clothes of conviction and wrapped in the language of opportunity. Here's the brutal truth most retail traders refuse to face. You're using the 1-hour chart to feel busy. Professionals use the same time frame to measure risk and harvest consistency. Same data, different identity, completely different results. You tell yourself, if I watch every candle, I won't miss the big moves. It sounds responsible. It sounds like commitment. But the data tells a different story. For most amateurs, every extra candle watched adds risk, not skill. Every refresh of the screen increases the probability of an emotional override. You think you're being diligent. You're actually feeding the beast of impulsive decision-making. There's a term for this: decision debt. Every time you check your position, every time you refresh that chart, you're borrowing against your future discipline. Each doubt corrodes confidence. Each screen refresh spends mental energy, and mental energy is finite. Eventually, that debt gets paid through poor choices. Moving stops without reason, taking profits too early, or adding to losers because you can't bear to be wrong. The 1-hour chart has become your enemy, not because of what it shows, but because of how you use it. You treat it like a slot machine, pulling the lever every 60 minutes, hoping this candle will be different. Meanwhile, professionals treat it like a precision instrument, waiting for specific conditions before they even consider touching their capital. Let me paint you a detailed picture of two traders. This isn't hypothetical theory. This is the reality of the market playing out every single day, captured in the data of thousands of trading accounts I've analyzed. Meet Trader A and Trader B. Both start on the first of the month with identical capital, $2,000. Both are trading the same instrument, years/USD. Both are looking at the same 1-hour chart glowing on their screens. Same market conditions, same news events, same volatility. The market doesn't care who they are. Trader A is the classic amateur, though he doesn't think of himself that way. In his mind, he's almost there. He knows patterns. He's watched hundreds of hours of educational content. He's memorized candlestick formations. But he hasn't accepted one fundamental truth. He is not a trader. He is a spectator who occasionally presses buttons. He risks based on what feels right in the moment. On Monday, he sees a decent setup and risks $50. He wins. He feels vindicated. On Tuesday, he spots what looks like a perfect setup. His confidence spikes. He tells himself, "This is obvious. This is the one." He sizes up to 315% of his account in a single trade. Why? Because he wants to grow fast. He wants the dopamine hit of a big win. He wants to feel like a genius. But the market turns against him. That perfect setup fails, and he loses the $300. Now he's angry. He feels the market owes him. The revenge trade comes next, another $300 to make it back. That fails too. In 2 hours, he's lost 30% of his capital. His position sizing is driven by conviction, not calculation. His stop losses are optional, sometimes placed, sometimes deleted when price gets close, because it will come back. He uses the 1-hour chart like entertainment, not like business operations. Trader B operates in a completely different reality. He's not more intelligent. He's not gifted with superior market intuition. He simply made one decision. I'm going to trade like a risk manager, not a gambler. He risks exactly 1% per trade, $20, not $19 one day and $65 the next. Exactly 1%. It doesn't matter if the setup looks perfect or just adequate. It doesn't matter if he feels confident or uncertain. The risk is always $20, maximum 2 trades per session, regardless of how many setups appear. Some days, 0 trades. His stop losses are fixed based on market structure, never on how much money he's willing to lose. If the 1H chart shows the last swing low 25 pips away, that's the stop. Not 10 pips because he's scared, and not no stop because he's overconfident. His position sizing is mathematical, not emotional. When Trader B loses, he loses exactly $20. When he wins, he makes $40 or $60. His nervous system stays calm because no single trade can damage him. His decision-making stays sharp because fear isn't clouding his judgment. After entry, he sets his stop and target as limit orders, then closes the platform. He doesn't watch every tick. He doesn't refresh the screen every 30 seconds. He understands that excessive monitoring leads to emotional interference with winning trades. Now fast forward 1 month. Same market conditions. Same opportunities available on the same 1H chart. Trader A sits at $600, down 70% from where he started. He's had some massive wins, he'll tell you about them in detail. I caught 120 pips in one move, he'll say proudly. But those 1 or 2 big wins are buried under a long list of chaotic losses. Mentally, he's exhausted. He's confused, because my analysis is good. He blames volatility, news spikes, market manipulation, anyone but the person in the mirror. Trader B sits at $2,540. That's a 27% return in 1 month. He didn't have a magic month where everything went straight to target. He had losers, strings of them. 3 in a row at one point. Each loss was exactly $20. It stung a little, but it never hurt. The winners were typically 2R, sometimes 3R. Nothing explosive, just disciplined repetition. He's not euphoric. He's calm. Because his outcome matches his design. The difference between $600 and $2,540 isn't intelligence. It's not some secret indicator or insider knowledge. Both traders might know the same patterns, follow the same economic calendar. The gap came from one thing: the existence of a systematic approach, what we call the $500 consistency formula. This formula isn't about magic setups or perfect market timing. Every trader sees the same patterns on the same 1H chart. The difference is what you do when you see them. It's about turning the 1-hour time frame into a precision instrument that manufactures $10 to $25 per risk unit, repeatedly, until $500 monthly profits feel normal instead of lucky. Most traders think $500 monthly sounds small. They want $5,000. They want $50,000. But here's what they don't understand. $500 monthly on a $2,000 account is a 25% return. Sustained over time, this approach doesn't just build accounts. It builds generational wealth through the power of consistent compounding. The amateur chases the home run. The professional stacks base hits until the scoreboard shows a blowout. The amateur wants to feel like a genius on every trade. The professional wants to feel nothing at all, just execution of a tested process. This isn't about finding better setups. It's about becoming a different person when you see those setups. Right now, you're probably Trader A. You might not risk $300 per trade, but you're risking variable amounts based on how you feel. You're checking positions every few minutes. You're moving stops when price gets close because you don't want to take the loss. These behaviors feel rational in the moment. Your mind creates stories to justify them. But the data doesn't lie. Variable position sizing, constant monitoring, and emotional stop management destroy more accounts than bad technical analysis ever will. In the coming chapters, you'll discover why waiting on the 1H time frame is actually a position. This sounds like a riddle, but it's the most important concept in trading psychology. You'll learn why your urge to trade every candle is your account's worst enemy. Most importantly, you'll get the exact mathematics that turn patience into profit. Not theory, not philosophy. The actual formulas that determine position size, risk per trade, and monthly profit targets based on realistic win rates and reward-to-risk ratios. But before we get to the mechanics, you need to confront something uncomfortable. The question isn't whether this approach works. The data doesn't lie. Thousands of trades across different markets and years tell the same story. Small, fixed risk plus structured 1H decisions equals survivable drawdowns and scalable profits. The question is sharper, and it's aimed directly at you. Are you ready to kill the amateur inside you who craves action, excitement, and the dopamine hit of clicking buttons? Are you ready to birth the professional who demands results over entertainment? who values boring consistency over exciting volatility. Because until that identity shifts, until you stop treating the market as an entertainment center and start treating it as business operations, no formula will save your account from that one destructive hour that's coming. The choice is yours. But the 1H data doesn't lie about what happens next. Imagine the market as a chaotic, high-stakes courtroom where billions of dollars hang in the balance every hour. The 1-minute and 5-minute charts are the frantic lawyers, shouting objections, presenting desperate evidence, throwing emotional arguments at the jury. They create urgency. They manufacture drama. They make every minor price movement feel like breaking news. But the 1-hour chart plays a completely different role. The 1-hour chart is the judge's gavel. And until that gavel bangs down, until that candle actually closes and the verdict is officially recorded, everything else is just noise masquerading as information. Amateurs trade the argument. They get swept up in the chaos of the lawyers, reacting to every shout and objection. Professionals trade the verdict. They sit back, arms crossed, waiting for the judge to deliver the final ruling. This distinction isn't philosophical wordplay. It's the single biggest technical reason why retail traders fail while professionals profit from the same market data. When you watch a 1-hour bar forming in real time, you are witnessing a battle in progress. You'll often see violent wicks, long tails shooting above resistance or plunging below support, representing failed attempts and trapped traders. Those wicks are the market's way of screaming not yet, or absolutely not. If you enter before the 1H close, you're gambling on incomplete information. You're betting on what the judge might say before the trial is over. When you wait for the 1H close, you're trading on established fact. The gavel has spoken. Let me show you exactly how this plays out in the trenches where accounts are made or destroyed, because understanding this concept intellectually means nothing if you can't recognize it when your capital is on the line. It's Tuesday morning. EUR/USD has been consolidating in a tight range for 3 days between 1.0850 support and 1.0920 resistance. Every trader watching this pair knows these levels. They're marked on thousands of charts around the world. The amateur and the professional are both watching the same screen, seeing the same data. But what happens next separates them completely. At 10:15 am, price sits at 1.0915. Just 5 pips below the resistance that is held for 3 days. The 5-minute chart shows a strong green candle forming with increasing volume. By 10:20, that candle breaks above 1.0920. It closes at 1.0925 on the 5-minute time frame. The breakout has happened. The amateur sees this and his nervous system explodes. His heart rate spikes. His palms get sweaty. This is it, he thinks. Clear breakout. Volume confirmation. 3-day range finally resolving. If I don't get in now, I'll miss the entire move. He buys aggressively at 1.0926, sizing up because the setup looks obvious. In his mind, he's being decisive while others hesitate. He places his stop at 1.0910, just below the breakout level, giving himself 16 pips of risk. The next 5-minute candle pushes higher to 1.0932. He's up 6 pips. His decision feels validated. His chest swells with pride. Another green candle takes him to 1.0938. Now he's up 12 pips. He's already calculating his profit, already imagining the trade recap he'll share later. Caught the breakout perfectly, he'll tell anyone who will listen. But something shifts in the market's undertone. The next 5-minute candle opens at 1.0938 and immediately reverses. It closes at 1.0928. Then 1.0922, then 1.0915. Within 15 minutes, all his paper profits evaporate like morning mist. His stop at 1.0910 gets hit. He's out with a 16 pip loss, confused and frustrated. It was a perfect setup, he tells himself. The market is just random. It's manipulated. But here's what he missed while he was busy being emotional. It's now 10:55 am. The 1-hour candle that opened at $10 am is about to close. When it does, it closes at 1.0912, well below the resistance level at 1.0920. The hourly candle shows a long upper wick that pierced resistance all the way to 1.0938, but completely failed to hold. This isn't a breakout candle. It's a rejection candle. A shooting star. A trap designed specifically to harvest amateur stops and trigger emotional entries. The professional trader watched this entire 45-minute sequence unfold and did absolutely nothing. No entry, no panic, no FOMO, no clicking. They simply waited for the 1H close, because they understand that intra-hour price action is often designed to exploit the exact behavior the amateur just displayed. When they saw the 1H close at 1.0912 with that massive rejection wick, they recognized the true message being transmitted by institutional money. The 1.0920 resistance level is being defended with serious capital. The breakout was false. The real opportunity is now on the short side. They enter short at 1.0910 with a stop at 1.0945, above the wick high and above the structural resistance. Their target is the bottom of the range at 1.0850, giving them a 60 pip target against a 35 pip stop. Nearly 2-to-1 reward to risk based on structure, not hope. Over the next 4 hours, EUR/USD grinds steadily lower. By 3 p.m., it's trading at 1.0855. The professional exits at their target, banking 55 pips of profit. Meanwhile, the amateur is already in 2 more trades, desperately trying to recover from that initial 16 pip loss, digging the psychological and financial hole deeper with each emotional decision. This is the profound difference between hoping and knowing, between reacting to a flicker of light and responding to a lighthouse beam, between amateur speculation and professional operation. Same market, same data available to both traders, but completely different outcomes, because one understands that the 1-hour close is the moment when noise crystallizes into signal. There's a term for what the amateur experienced: decision debt. Every time you check your position before the hourly close, every time you refresh that chart, you're borrowing against your future discipline. Each doubt corrodes confidence. Each screen refresh spends mental energy, and mental energy is finite. The amateur spent 45 minutes burning through his decision-making reserves, making it inevitable that fear would eventually override his original plan. The professional avoided this trap entirely by understanding a simple truth. If you entered based on incomplete 1H information, you must manage based on incomplete 1H information. The market doesn't care about your 5-minute analysis. It cares about where institutional money decides to make its stand after a full hour of price discovery. Jesse Livermore, the greatest trader in history, spoke often of pivotal points, specific price levels where the market's true intention reveals itself through the action of informed money. But in our modern era of high-frequency trading and algorithmic noise, we need to adapt his wisdom. On a 1-minute or 5-minute chart, every level looks pivotal. Every minor support looks like bedrock. Every minor resistance looks like an impenetrable ceiling. It's a hall of mirrors designed to confuse and extract capital from the unwary. On the 1-hour chart, however, the noise gets filtered out by time and volume. Only the real pivotal points survive 60 minutes of institutional voting with billions of dollars. If a level holds for an hour under pressure, it matters. If a level breaks and closes beyond the break after an hour of testing, it matters. The 1H chart strips away the deception of lower time frames and reveals the raw intent of the market makers. The rule you must adopt is absolute, and you need to tattoo it on your trading consciousness. 1H data doesn't lie, but it takes 60 minutes to tell the truth. Anything before that close is speculation. Anything after that close is confirmation. You cannot shortcut this process. You cannot get in early without accepting that you're front-running the verdict and gambling that your guess matches what the judge will eventually rule. This patience provides you with another massive edge that most amateurs completely overlook: rational stop placement. Stop losses aren't just about protecting money. They're about defining where your trade idea gets proven wrong by market structure, not by your emotions. On a 5-minute chart, your stop might be 10 pips away, just beyond the last swing low. But here's the fatal flaw: 10 pips is noise, not structure. Normal intra-hour volatility in major pairs often ranges from 15 to 25 pips. You're placing your stop inside the noise zone, guaranteeing that normal market breathing will trigger your exit before your thesis has a chance to play out. You'll be right about direction and still lose money because your stop was structurally irrelevant. On a daily chart, your stop might be 200 pips away, below the last major swing low that formed 3 days ago. This is structurally sound, but now you face a different problem: position sizing mathematics. If you're risking 1% of a $2,000 account, $20, and your stop is 200 pips away, your position size becomes 10 cents per pip. You're trading a micro lot. Even if you're right and price moves 200 pips in your favor, you make $20. The reward doesn't justify the time, attention, and emotional energy required. The 1-hour chart exists in the Goldilocks zone. It gives you stops of 20 to 40 pips based on actual market structure, the last hourly swing high or low, or key support and resistance levels that have been tested with real volume over real time. These levels are far enough away that normal volatility won't stop you out, but close enough that you can size positions meaningfully without destroying your risk management. If you're risking $20 and your structural stop is 25 pips away, your position size becomes 80 cents per pip. A 50-pip winner gives you $40. A 75-pip winner gives you $60. These are meaningful returns on controlled risk, all derived from structure rather than arbitrary fear levels or greed-driven targets. When you trade the 1-hour verdict, your stop-loss transforms from a target into a shield. You're placing it behind a wall of proven institutional defense. For the market to hit your stop, it has to prove that the 1-hour trend has actually changed. If that happens, you want to be out anyway, because your original thesis has been invalidated by the very time frame that confirmed it. This is why professionals obsess over the 1-hour time frame. It's not because they lack the attention span for daily charts or the discipline for 5-minute scalping. It's because the 1H chart provides the optimal balance between signal clarity and position sizing efficiency. It filters out enough noise that you're not getting chopped to death by random fluctuations, but it provides enough trading opportunities that you're not waiting weeks between high-probability setups. But here's what most educational content will never tell you. What separates this approach from the typical wait-for-confirmation advice you've heard before? Knowing when to enter based on 1H closes is only half the equation. You can have perfect entry timing. You can wait for every 1H close like a seasoned professional. You can place stops at structurally sound levels based on proven institutional defense zones. But if you're risking 5% per trade one day and 0.5% the next, if you're sizing positions based on conviction rather than calculation, you're still an amateur wearing professional clothing. The other half of the equation, the part that separates consistent winners who extract money from the market every month from occasional lucky streakers who eventually give it all back, is knowing exactly how much to risk once that 1-hour signal confirms. It's about taking that 30 pip stop distance and translating it into a dollar amount that allows you to sleep peacefully at night and profit systematically during the day. This is where we transition from the courtroom of market psychology to the laboratory of trading mathematics, where the $500 consistency formula stops being a concept and starts becoming a concrete, repeatable protocol that works regardless of market conditions. Here's the paradox that quietly destroys most trading careers before they even begin. You're chasing $500 monthly profits while risking $200 per trade. You're trying to build a skyscraper with dynamite instead of bricks. You want consistency, but your position sizing is pure chaos. You dream of professional results while operating with amateur mathematics that guarantee failure. Professionals do the exact opposite. They chase flawless execution on tiny, controlled risk and let basic mathematics build the $500 through repetition and discipline. They understand that trading isn't about hitting a jackpot or catching the trade of the year. It's about operating a factory that manufactures small wins over and over again, so consistently that $500 monthly feels inevitable rather than lucky. This reversal of thinking, from reward first to risk first, is the single most important mental shift you will ever make as a trader. Until you make this shift, you're not trading. You're gambling with extra steps, fancier terminology, and better charts. But you're still gambling. Let's wire this concept directly into your 1H framework with real numbers, real scenarios, and real mathematics that you can implement immediately. No theory, no philosophy. Just the actual formula that separates amateurs who blow accounts from professionals who build them systematically. The foundation. Your unit of pain. Assume a $2,000 account. This is realistic for most serious beginners who are past the trying it out with $100 phase but not yet at institutional capital levels. You're trading real money, enough that losses register emotionally, but not so much that a bad month destroys your financial life. A professional trader with a $2,000 account doesn't start by asking how much can I make this month. They start by asking how much can I lose safely on each trade without damaging my capital base or my psychological stability. The answer, refined through decades of trading research and thousands of real accounts, typically falls between 0.5% and 1% per trade. Let's use 0.75% for our working formula. 0.75 per dollars, $2,000, $1,000 risk per trade, not $150, not whatever feels right. $15, period. Every single trade, regardless of how confident you feel, regardless of how obvious the setup looks, regardless of whether you just had 3 winners in a row or 3 losers. The risk is always $15. This becomes your unit of pain, the amount small enough that fear doesn't hijack your decision-making process, but large enough to create meaningful results when multiplied across dozens of trades. When you lose $15, it registers. You feel it, but it doesn't trigger panic. It doesn't make you want to immediately make it back with a revenge trade. It doesn't keep you awake at night. It's pain with purpose, not trauma. The universal formula: position size is survival tool. Now consider your typical 1H setup based on everything we established in the previous chapter. You're trading a range breakout with retest on EUR/USD. The 1-hour candle has closed above resistance at 1.09 Turo, pulled back to retest that level at 1.0915, and is now showing bullish confirmation. Your entry is at 1.0918. Your stop loss, based on 1H structural analysis, needs to be below the retest low with a small buffer for normal volatility. That places your stop at 1.0898, giving you exactly 20 pips of risk from entry to stop. Here's where most traders get lost. They know they want to risk $15, and they know their stop is 20 pips away, but they have no idea how to translate that into actual position size. They end up guessing, or worse, they use whatever their broker's default lot size happens to be, completely disconnecting their risk management from their actual trade structure. The formula is brutally simple. Position size, DEC. Stop distance. Dollar risk. NAR claw, 20 pips. $15. NAR claw lower and 75 per pip. In Forex terms, that's approximately 0.075 lots, which you'd round to near 0.07 or near 0.08 lots, depending on your platform's minimum increments. This precision matters enormously. You're no longer feeling your way into position size based on conviction or emotion. You're calculating it with mathematical precision before you ever click the entry button. This is the universal formula that governs professional survival: position size equals dollar risk divided by stop distance. It doesn't matter if the stop is 10 pips or 100 pips away. It doesn't matter if you're trading Forex, stocks, or commodities. Your dollar risk remains exactly $15, and your position size adjusts automatically to maintain that fixed risk level. The monthly mathematics, building the $500. Here's where the real power of this approach reveals itself. It's not in any single trade. It's in what happens when you execute this formula consistently across dozens of trades over weeks and months. Let's model a realistic month of trading to see how the mathematics compound into that $500 target. Assume you take 30 high-quality trades over 1 month. That's roughly 1.5 trades per day across 20 trading days, which is achievable if you're monitoring the 1H chart during active sessions without overtrading. Your win rate, if you're properly selecting 1H setups based on the principles we've discussed, should be around 50%, not 80%, not the fantasy numbers that course sellers promise. A realistic, sustainable 50% win rate. Your reward to risk ratio on winners is 2 to 1. For every $15 you risk, you're targeting $30 in profit. This is conservative and achievable with proper 1H structure-based targets. The basic mathematics look like this: 15 losing trades, $15 plus $225 in total losses. 15 winning trades plus 30 plus 450 in total gains. Net result, plus 225 for the month. That's an 11.25% return on your $2,000 account in 1 month, achieved with a 50% win rate and disciplined 2-to-1 targeting. No heroics, no perfect market calls, no home runs, just systematic execution of a mathematical edge. But here's the multiplier effect that bridges the gap to $500. What happens when you tighten your selection criteria even further? What if instead of taking 30 trades per month, you become more selective and only take the absolute best 1H setups, the A-plus opportunities where multiple factors align? Your trade count drops to 20 per month. 10 losing trades, $15, AUX, $150 in total losses. 10 winning trades, plus 30, plus 300 in total gains. Net result, plus 150 for the month. At first glance, that looks worse. But we haven't factored in the psychological advantage and the reality of how trends actually develop. In any given month, regardless of market conditions, you'll encounter 2 to 3 trades where the 1H chart shows clear, sustained, directional bias. These are the trending days where your initial position moves strongly in your favor and the structure supports letting the trade run beyond your normal 2R target. These runner trades don't just hit your $30 target and stop. They extend to $3 to $1 $45, sometimes $4 to $1 $60, as the trend develops over multiple hours. Let's be conservative and assume you catch just 3 runner trades per month that hit 3 to 1 instead of 2 to 1. Your revised monthly picture. 10 losing trades, $15, $150, 7 normal winners plus 30, plus 210, 3 runner trades plus 135. Total profit, 210 plus 135, $150, 195. We're getting closer to $500, but there's one more factor that makes this formula truly powerful: compounding growth. How $225 becomes $500. As your account grows from successful months, your 0.75% risk per trade grows proportionally. This is where the mathematics become truly powerful. After 3 months of $200+ profits, your account has grown from $2,000 to approximately $2,600. Now your 0.75% risk per trade is $19.50 instead of $15. The same 50% win rate and 2 to 1 ratio now generates larger absolute dollar profits because your position sizes have grown with your capital. Month 4 calculations. 10 losing trades, $19.50 else $195. 7 normal winners plus 39, $273. 3 runner trades plus 58.5 plus 175.50. Total profit $273 plus 195, $253, 150 cents. By month 6, with continued growth, you're consistently hitting the 300-400 range. Add slightly better selection, 1 additional runner per month, or a modest improvement in win rate from 50 to 55%, and you're solidly in the $400, $500 monthly range. All while never risking more than 0.75% per trade. All while maintaining complete emotional stability because no single trade can damage you. The devastating contrast. Now contrast this systematic approach with how the amateur operates. The amateur sizes positions based on conviction and emotion. On Monday, they risk $50 because the setup looks decent. They win and make $100. Their confidence spikes. On Tuesday, they see what appears to be an even better setup. They tell themselves this is the one and risk $300, which is 15% of their account, in a single trade. Why? Because they want to grow fast. They want the dopamine hit of a big win. They want to feel like a genius. But the trade fails. They lose $300. Now they're angry and want to make it back. The revenge trade comes next. Another $200 on a marginal setup that doesn't meet their criteria. It fails too. In 3 days, they've lost $500 from a $2,000 account. Their capital has shrunk to $1,500, and their nervous system is completely shattered. The mathematics of recovery are brutal. They now need a 33% gain just to get back to break even, and they need to achieve that gain while operating from a place of fear and desperation. The professional, meanwhile, has had the same 3 losing trades. They risked $15 on Monday and lost $15. They risked $15 on Tuesday and lost $15. They risked $15 on Wednesday and lost $15. Their account sits at $1,955, essentially unchanged, and their nervous system remains calm and capable of executing the next high-probability setup without emotional interference. This is the profound difference between focusing on how much you can make versus focusing on how much you can afford to lose. The amateur's reward first thinking creates massive volatility in both capital and psychology. The professional's risk first thinking creates stability in both, and stability is the foundation upon which consistency is built. Where mathematics meet human nature. The formula itself is so simple that a fourth grader could execute the calculations. Position size equals dollar risk divided by stop distance. That's it. There's no complex algorithm, no proprietary indicator, no secret sauce. The mathematics are transparent and universal. But here's what the spreadsheets and formulas don't show you, what no amount of backtesting can prepare you for. The psychological warfare that begins the moment you click buy or sell with real money on the line. You can know the formula. You can calculate position size perfectly. You can have $15 risk in a 20 pip stop, and $0.75 per pip position size all dialed in before entry. But the moment that position goes live and real money is at stake, your primitive brain activates. The price moves 5 pips against you, and suddenly that $15 risk feels enormous. You think about moving your stop closer to protect capital. The price moves 10 pips in your favor, and you think about taking profits early, before the market takes it back. When you risk $15, you are essentially buying information from the market. You are paying a small fee to see if your 1H analysis is correct. If it is, the market pays you back your fee plus a profit. If it isn't, the fee is gone, but your business remains open for the next opportunity. When you risk $200 on a $2,000 account, you aren't buying information. You're betting your survival on a single outcome. The $500 consistency formula is boring. It's repetitive. It lacks the adrenaline rush of the all-in moment. And that is exactly why it works. It removes the emotional spikes that cause you to make stupid decisions. When your risk is small and fixed, a loss is just data. It's a business expense, like paying for electricity or internet. It doesn't trigger your fight or flight response. This is where 90% of traders sabotage their own formulas. The mathematics are simple and proven. The execution under live market pressure, with your own capital at risk and your ego invested in being right, is where the formula either becomes your fortune or becomes another abandoned system in a long list of things that didn't work. The mathematics assume you will actually take the stop at $15. They assume you won't move the stop to give it more room and turn a $15 loss into a $50 loss. They assume you will actually hold the winner to $30. They assume you won't panic and close it at $10 because you're afraid the market will turn. The spreadsheet is perfect. You are not. And that's exactly what we need to address next: how to survive the emotional assault that comes with every trade, and how to protect your carefully calculated positions from the most dangerous enemy you'll ever face in the markets: yourself. You've executed the plan perfectly. Entry based on 1H confirmation, position sized at exactly $15 risk, stop placed where structure says your thesis is wrong, target set at 2R. You clicked buy. The mathematics are flawless. The analysis is sound. The hardest part is over, right? Wrong. Dead wrong. The hardest part is just beginning, because now you must do the most difficult thing in trading, the thing that separates professionals from amateurs more than any technical skill: absolutely nothing. Here's the cruel irony that destroys most 1H traders. The slower pace of hourly candles doesn't reduce psychological pressure. It amplifies it. On a 5-minute chart, trades resolve quickly. You're in and out within an hour. There's barely time to think, let alone spiral into anxiety. But on the 1-hour chart, you have time. Too much time. Time to imagine every possible disaster. Time to second-guess your analysis. Time to refresh the screen 47 times and check your floating P&L every 90 seconds. The amateur becomes a nervous wreck the moment his position goes live. He refreshes the trading platform every 30 seconds like a teenager checking social media for validation. He watches every tick like a hawk stalking prey, his heart rate spiking with each minor price movement. His mind, desperate for certainty in an uncertain environment, creates elaborate disaster scenarios that have nothing to do with actual market structure. What if it gaps against me? He thinks. even though he's trading during active session hours? What if the stop gets hit, and then it reverses without me? This is his greatest fear, being stopped out and then proven right, which would be psychologically devastating. What if I'm missing a better setup right now while I'm stuck in this trade? Now he's not just worried about the current position failing, he's worried about opportunity cost. This internal dialogue is pure poison. Each doubt corrodes confidence. Each what-if scenario erodes discipline. Each screen refresh spends decision energy, and decision energy is finite. You wake up each day with a limited reserve of willpower and rational thought. Every trivial check, every moment of anxiety, every refresh draws from that reserve. There's a formal term for this phenomenon: decision debt. Every time you check your position without valid reason, you're borrowing against your future discipline. You're spending mental resources now that you'll desperately need later when something actually requires your attention. Eventually, that debt gets paid through poor choices, moving stops without structural justification, taking profits too early because you can't handle the anxiety, or adding to losers because you can't accept being wrong. The professional operates in a completely different reality. They understand that once the trade is placed with defined risk and target, staring at live price action adds zero value. It doesn't improve decision quality. It doesn't change the structure that justified the trade. It only magnifies noise and accelerates decision debt. So the professional does something that feels counterintuitive to the amateur mind. They set the trade and walk away. Literally. They close the trading platform. They go do something else. They trust that if something important happens, stop hit or target reached, their alerts will notify them. Here's the protocol that changes everything. After entry, immediately set your stop loss and take profit as hard limit orders in your platform. Not mental stops, not I'll watch it. Actual pending orders that execute automatically. Then close your trading software completely. Not minimized, closed. Set price alerts on your phone for your stop level and target level. Return only when an alert fires or at the next hourly candle close. Let me share what happened to a trader named Ben who discovered the transformative power of non-interference. Ben was intelligent, solid technical analysis, good risk management mathematics. But he was a chronic position watcher. The moment he entered a trade, he would stare at screens for hours, monitoring every tick, imagining every possible outcome. His 6-month data revealed the problem. Win rate, 52%, perfectly acceptable for profitable trading. But his average winning trade was only $320, while targeting $600 based on structural levels. Why? Because he consistently exited winners early. Every time a trade moved in his favor and then pulled back normally, his anxiety would spike. He'd imagine the entire profit disappearing. He'd tell himself, a profit is a profit, and close at $320. Then he'd watch in frustration as price continued to his original target, proving his analysis was correct, but his execution was sabotaged by fear. I gave him one rule: close the platform after trade entry. Don't check it. Don't peek. Set your stops and targets as limit orders. Close the software, and don't reopen it until an alert fires. His resistance was intense. It felt like abandoning the trade, like being irresponsible. But after 4 weeks of discipline, his data transformed completely. Win rate stayed at 52%, exactly the same. But his average winning trade jumped from $320 to $510. His monthly P&L increased from $2,100 to $6,400, a 200% improvement achieved purely through better behavior after entry. The data doesn't lie. Less interference equals better performance. Now let's address the most seductive trap in 1H trading, the break-even stop. You enter a trade, it moves 15 pips in your favor, and anxiety whispers, move your stop to break even. That way, you can't lose. Risk-free trade. This sounds intelligent. It feels like prudent risk management. It's actually self-sabotage dressed as discipline. When you move your stop to break even, you're using your entry price as the exit level instead of market structure. The market doesn't know where you entered. It doesn't care. It's going to retest the breakout level, wick you out at break even, then run to your original target without you. You were right about direction, but you made zero profit because you tried to eliminate risk before the structure allowed it. The professional keeps stops at structural levels until the trade shows significant profit, usually 2R or better. They understand that sometimes a winning trade will turn into a full loss. That's the cost of doing business, the price you pay for the opportunity to catch the runners that build careers. If you entered based on 1H data, you must manage based on 1H data. The tape is delivering a verdict, not starting a conversation. You don't negotiate with a judge after the gavel bangs. You accept the ruling. Your job isn't to control the outcome. You can't. Your job is to execute the process, identify the setup, calculate the risk, place the order, set the stop and target, walk away. Everything else is ego, trying to assert control over chaos. The hardest part of trading isn't analysis or mathematics. It's sitting with discomfort when money is at risk. It's resisting the urge to do something, anything, to relieve the anxiety of uncertainty. The amateur loses this battle daily. The professional wins by refusing to fight. They simply walk away and let the 1H chart do its work. Master this psychological warfare, and you've conquered the market's greatest weapon against you, yourself. That's where the $500 consistency formula transforms from theory into systematic wealth accumulation, one undisturbed trade at a time. Let's close the loop and transform everything we've discussed into a concrete daily operating system that manufactures $500 monthly profits with the predictability of a factory assembly line. No more theory, no more hoping, just a systematic routine that separates professionals who extract consistent money from the market from amateurs who oscillate between euphoria and despair. You don't rise to the level of your goals, you fall to the level of your systems. The $500 consistency formula isn't an idea you believe in, it's a way you operate every single trading day. Think of your trading day as a precision machine with 3 distinct phases. Each phase has a specific job, specific rules, and specific outcomes. You don't improvise. You execute. Pre-session planning. 15 to 20 minutes. Before the market opens, before that first candle prints, before you have any emotional attachment to price movement, you become a strategist, not a trader. You're an architect designing the blueprint, not a construction worker swinging a hammer. This distinction matters because a trader reacts to what's happening, while a strategist designs what should happen. Open your platform and go straight to the 1-hour chart of your chosen instrument. No news feeds. No social media. No scanning 20 different pairs looking for action. 1 to 3 markets maximum. You're not trying to catch everything, you're trying to catch the cleanest moves in your chosen battlefield. Mark the key 1H levels from overnight action and the previous session. Identify the obvious support and resistance zones that have been tested multiple times. Where are the pivotal points? Those specific price levels where institutional money has shown a willingness to defend or break through. These aren't arbitrary lines. These are zones where billions of dollars have voted with real capital. Then write down, in plain language, your A+ setup criteria for the day. 1 or 2 patterns only. For example, I will only trade confirmed 1H breakouts that retest and hold with rejection wicks, or I will only trade pullbacks to the 21-period moving average in the direction of the dominant 1H trend. You're pre-committing to specific conditions while your mind is calm and rational, not in the heat of the moment when fear and greed cloud judgment. Most importantly, decide your maximum trades for the session, 1 to 3, never more. Write it down, maximum trades today, 2. This number becomes non-negotiable once the session begins. It forces you to treat each trade like precious capital, not like lottery tickets. It also creates a circuit breaker that prevents revenge trading when something goes wrong. This 15-20-minute planning session is your foundation. Skip it, and everything that follows becomes reactive gambling. Execute it consistently, and you've already separated yourself from 80% of retail traders who open their platforms asking, "What can I trade today?" instead of "Under what conditions will I trade today?" Execution window, 3 to 5 hours. You now have one job, and it's the hardest job in trading. Wait. Not look for setups. Not stay active. Wait. You're waiting for the market to deliver your predefined A+ pattern. Either it appears exactly as you specified, or it doesn't. There are no exceptions, no close enough compromises, no FOMO-driven entries because you're afraid of missing out. Waiting is a position. This concept separates professionals from amateurs more than any technical skill. When you're waiting, you're not doing nothing. You're actively preserving capital, protecting your decision-making energy, and positioning yourself to act decisively when the right opportunity appears. You're like a sniper lying in position. You're not shooting at everything that moves. You're waiting for the specific target profile you defined in Phase 1. The amateur feels anxiety during this silence. They feel like they're missing out or wasting time. They start rationalizing marginal setups because they need action. The professional understands that this patience is where the money is made. Every minute you don't trade a subpar setup is a minute you preserve capital for the high probability opportunity. When, and only when, price delivers your specific pattern, you switch from patient observer to mechanical executor. You don't hesitate. You don't ask for confirmation from social media. You don't second-guess your analysis. You act with precision. Calculate your position size using the universal formula, dollar risk divided by stop distance. If you're risking $15 and your structural stop is 25 pips away, your position size is 60 cents per pip. Set your stop loss based on 1H structure, where your thesis gets proven wrong, not where your emotions feel comfortable. Set your target at minimum 2R, positioned at the next logical structural level. Execute the trade, and immediately set your stop and target as hard limit orders in your platform. Close the trading software completely, not minimized, closed. Set price alerts for your stop and target levels. Return only at the next hourly candle close or when an alert fires. This platform closure is crucial. After entry, your job isn't to babysit the trade. Your job is to let the 1H structure prove you right or wrong without emotional interference. Every minute you spend watching live price action after entry increases the probability of sabotaging your own setup. If you hit your maximum trade count for the day, whether those trades were winners or losers, you're finished. You don't chase. You don't take just one more. Waiting becomes your position again. This isn't laziness. This is professional discipline that recognizes the diminishing returns and increasing risks of overtrading. Post-session review, 20 to 30 minutes. This phase separates the 1% from the 99%. Most traders end their day by checking their P&L and feeling either elated or depressed based on the number. Professionals end their day by conducting a systematic audit of process, not outcome. You're not judging whether you made or lost money today. You're auditing whether you followed your process. These are completely different activities with completely different long-term implications. Open your trading journal and ask these 4 brutal questions with complete honesty. Did I respect my predetermined risk of $15 per trade, or did I size up because I felt confident about a setup? Did I move my stop loss without structural justification, either widening it to avoid being wrong or tightening it impulsively to protect capital? Did I exit winners early due to fear of losing floating profit? And if so, at what point did I cut the trade, and what did the chart structure look like? Did I skip valid A-plus setups because I was afraid after a previous loss, or because I was distracted by other opportunities? Write these answers honestly. No excuses. No stories about market manipulation or unfair conditions, just facts about your behavior under pressure. You're building a database of behavioral patterns that reveals your specific psychological weaknesses. Within 2 to 3 weeks of disciplined review, patterns emerge that are more valuable than any technical indicator because they address the real problem, your response to uncertainty and risk. The monthly mathematics. Building the $500. Let's model exactly what this 3-phase routine produces over 1 month of disciplined execution. These aren't fantasy numbers. They're realistic projections based on proper 1H setup selection and fixed risk management. 20 trading days multiplied by 1.5 quality trades on average equals 30 total trades for the month. Some days you take 2 trades, some days 1, some days 0, based on your A-plus criteria. Your risk per trade remains exactly 0.75% of your $2,000 account, which equals $15 every single time, regardless of how confident you feel about any particular setup. With proper 1H selection based on structural confirmation, your win rate should realistically hover around 55%. Not the 80% fantasy numbers that course sellers promise, but a sustainable 55% that accounts for the inherent uncertainty of markets. Your reward-to-risk ratio averages 2R on standard trades, with 2-3 runner trades monthly that extend to 3R when trends develop and structure supports letting them run. Here's the realistic mathematical breakdown. Total monthly trades, 30. Win rate, 55%. Sing cents in winners, 13-14 losers. Losses, 14-15 210. Standard winners, 13-30 390. Runner trades, 345s 135. Total monthly profit, 395 210 315. That's a 15.75% monthly return on your $2,000 account, achieved without heroics, without perfect market timing, without catching the trade of the year. Just systematic execution of a proven process where the mathematics of edge compound into consistent profitability. Add slight improvements in execution, one fewer impulsive stop move, one additional runner held properly to 3R, and you climb toward $400, then $500. All while maintaining controlled drawdowns that your mind and your account can survive. Closing the loop, the identity transformation. Remember our opening comparison from Chapter 1. Two traders, identical starting capital of $2,000, same market conditions, same 1H chart available to both. Trader A, operating with emotional position sizing, constant screen monitoring, break-even stops, and revenge trading, ended his month at $600, down 70%. His equity curve resembles a heart monitor during cardiac arrest, explosive gains followed by devastating losses. His nervous system is shattered. He's confused, angry, blaming external factors. He's probably already searching for a new strategy, a new indicator, a new guru to follow, because he can't accept that the problem isn't his analysis, it's his behavior. Trader B, operating with systematic 0.75% risk, disciplined 1H execution, and zero interference after entry, ended his month at $2,040, up 27%. His equity curve isn't a straight line, it has drawdowns and choppy periods. But the direction is unmistakably clear, up and to the right. His nervous system remains stable. He's not euphoric, because he understands this is just process playing out over time. He's already planning next month's targets, already thinking about how to refine his setup selection. Which trader's nervous system can sustain this approach for 5 years? Which approach scales as account size grows from $2,000 to $20,000 to $200,000? Which method survives market regime changes when volatility spikes, trends disappear, or black swan events disrupt normal patterns? The data provides the answer without emotion. The trader who lives the routine, who treats trading as systematic business operations rather than entertainment or gambling. Your operating maxims, the DNA of professional trading. Engrave these 4 principles into your trading consciousness. Waiting is a position. You're not doing nothing when you're waiting for your A-plus setup. You're actively preserving capital and decision-making energy for the moment of highest probability. Flat is a valid position when the market doesn't meet your predefined criteria. Position size is survival. Your 0.75% risk per trade isn't a suggestion, it's your seatbelt. You don't unbuckle just because the road looks clear. Your edge isn't in your analysis, it's in your ability to survive long enough for your edge to express itself across hundreds of trades. The tape delivers verdicts, not conversations. The 1H close is the judge's final ruling. You don't argue with it, negotiate with it, or try to predict what it will do before it happens. You align with confirmed price action, or you step aside. You need more discipline per trade, not more trades. Taking 30 quality trades monthly with perfect execution beats taking 200 marginal trades with emotional interference. Volume of execution doesn't replace quality of execution. Your next step, from theory to personal proof. If this resonated, if you felt the truth in these principles, your next step is brutally simple and absolutely crucial. Choose one 1H setup, not 5 different patterns. Not a complex system with multiple time frames. One setup. Maybe it's range breakouts with retest confirmation. Maybe it's trend continuation pullbacks to moving averages. Maybe it's rejection candles at key structural levels. Define this setup precisely in writing. What does it look like? What confirms it? What invalidates it? Then commit to trading only this pattern for your next 50 trades with the 3-phase routine: plan, execute, review. Document everything in a trading journal, every entry, every exit, every emotion, every rule violation. After 50 trades, your personal data will prove what the professionals already know. The $500 consistency formula works if you work it. You're not just aiming for $500 monthly. You're building a systematic approach that scales far beyond it. When your $2,000 becomes $10,000, your 0.75% risk becomes $75 per trade, and the same process generates $2,500 monthly with identical risk management. The 1H data doesn't lie. Your consistency around it determines everything. The market will be here tomorrow, next month, next year. The question is whether you'll still be here, capital intact and growing, or whether you'll be another statistic in the 90% who blow their accounts chasing excitement instead of building systematic wealth. The choice has always been yours. But now you have the blueprint. Execute it with the discipline it demands, and the $500 monthly becomes the floor, not the ceiling.